From New York City, for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, Powell's higher for longer message at Wednesday's meeting sends yields soaring to the highest levels in over a decade and prompts fresh default fears as borrowing costs rise. We begin with the big issue: how high and for how long?
The Fed made it pretty clear that
the rates will be higher for longer.
Higher for longer.
Higher for a little longer.
Higher for longer.
This was a very hawkish pause.
potentially one more rate hike coming.
The market is pretty much pricing in the Fed scenario.
They basically think a soft landing is more likely.
They're banking in the soft landing, right? But they're saying GDP is still going to be sluggish.
In terms of the forecast, there are some real questions that need to be answered.
We all have forecasts, and most likely they're all wrong.
Probably raise in November.
We don't have the Fed taking any steps of action until March of 2024.
I think the Fed will cut rates even if the inflation rate doesn't get to their 2% target.
Through 2024, I think there's real scope for rate cuts to seriously overwhelm market expectations and for yields to push much lower.
The Fed wants to be cautious about when they start to cut.
Take the Fed's message with a fair bit of skepticism.
There's still a lot of uncertainty.
Joining us now, I'm thrilled to say we have Jay Barry, co-head of U.S. rate strategy at JPMorgan, and Morgan Stanley, global director of fixed income research, Vishy Tirupattur. And Jay, I'll start with you because it feels like the conversation has really shifted over whether or not they're going to go again to how long this Federal Reserve could stay on hold. After what we heard from Jerome Powell this week, how long do you think that we're going to stay at that eventual terminal rate?
Sure, Katie, and thanks for having me this afternoon. So it's been our view at JPMorgan that we think that the Fed is likely done tightening here, and that's been our view for some time. And certainly the risk is to one more hike, but we think once they're on hold, they're likely on hold for the next year or so. And we don't actually envision the Fed lowering rates until the third quarter of 2024. And certainly we do see growth decelerating from here after strongly above trend growth to start the year through the middle of the year. But against the backdrop of an economy that's likely to move below trend into next year, but inflation that should remain elevated, we think the Fed's on hold for an extended period. Although it's unlikely the market's going to get this clear, I think for at least a few months, because with the dots still indicating one more hike is likely, we do think it's going to take the data panning out over the next few months to really get certain about this.
Well, Jay, how much stock do you put into the idea that, OK, we could see the Fed cut, not because we're heading into a downturn or because a recession arrives, but just because they want to get back to more neutral territory?
I think it's our view here, Katie, that as inflation eases over the course of the next year, real policy rates will be getting more restrictive. So at some point when the Fed is comfortable that inflation is getting back closer to its target, it will leave room to ease, if anything, to kind of prevent rates from becoming more restrictive, then to getting closer back to neutral. We actually think that the pathway back to neutral is going to be relatively slow, because even though we see growth slowing, it's hard for us to pick out some sort of nonlinearity here amongst consumers or corporates or even state and local governments to make you think that a bigger downturn is coming, at least with what we know right now.
And Vishy, on that long, slow path back to neutral, where do you fall on the duration argument? Are you stepping out the curve here, or would you wait?
We are constructive on duration here. I think I agree with Jay that our research view is also that the Fed is done here, and I fully acknowledge that the median dot plots have indicated another hike. But we think Fed is done here. I think the point of some disagreement with Jay for me would be that I think we are more optimistic on the deflationary process, perhaps compared to the market, and thus far how the PCE has unfolded is very much in line with our expectation. And if this process continues to be the case, we think that there will be in conjunction with a slowing of the employment scenario as well. We think there will be a reasonable chance that end of Q1 we will see the Fed cutting. And once again, Fed cutting not to stimulate the economy, but beginning the process of gradually moving to a more normalized monetary policy path.
What gives you confidence in that path of deflation? Because, for example, you look over the past few weeks, you've seen energy prices rise very significantly. You're starting to see that filter through break-even rates, for example. When you look out over the next few months, over the next year, what makes you confident that we'll continue to see inflation come down?
A number of things. First, of course, the Fed thinks more in core PC terms. And some of the more volatile energy prices will affect more of the headline inflation. But I think the more important thing is that we expect that the growth spurt that we saw in the third quarter comes from some of the one-off events, and we see considerable amount of economic headwinds to the market, facing the economy. We'll see clearly the UAW strike is going on, perhaps expanding a bit. There is a high likelihood of a government shutdown, the student loan payments come back into play. All of those things, in our mind, would mean that a meaningful slowing is ahead. And if you look at the median expectation from the dot plot from the Fed, to get to the 3.7% core PCE by the end of the year, between now and end of the year, we would need to see month over month inflation core PC numbers average about 33 basis points. Our expectation is closer to 20 basis points. In fact, our number for the next data point is 14 basis points. So you need to see the progress that's been happening in core PCE has to be undone and revert into a very different trajectory, which something, given the economic environment, given all the economic clouds that are out there, we think that's pretty confident about our expectation about the deflationary process.
Well, Jay, Vishy brought up the government shutdown, potentially. And it's interesting, going through your research, you put out a note in the past few weeks saying that if you think about the setup now heading into this potential shutdown, unlike previous episodes, Fed policy is actually pretty tight. If we do see the government shut down, how might that play out?
Yeah, I think it's interesting, Katie, that in each of the last three big government shutdowns we've seen, in 95, 96, in 2013, and again in 2018-19, Treasury yields have trended lower. And you're right, it's because in each of those instances, the Fed was either easing or pivoting more dovish. Whereas right now, we're in an environment where the Fed is leaning towards potentially another hike, and that's not necessarily wanting to sort of sell any optionality. So we think that the impact on Treasury yield is likely to be much more neutral this time around, unless there's a real sharp shift in risk sentiment. And the thing that actually concerns us is there's an acute awareness and concern on fiscal right now, on spending and on Treasury supply. And to the extent that has manifested itself with an increase in term premium over the course of the last couple of months, and we even heard Chair Powell talk about that on Wednesday, that's something that may actually even pressure Treasury yields modestly higher if we have a shutdown, which seems like it's becoming increasingly likely.
And Vishy, weigh in on that, because as Jay walked out, again, we're looking at a pretty tight stance of monetary policy. You look at 10-year yields right now at 4.42%. If you think about the possibility of a shutdown, how much agita is that giving you?
I think it depends on, there is plenty of agita. But I think what really matters is how big is the shutdown? Is it a partial shutdown? How many departments do get shut down? And how long the shutdown lasts? If it is a matter of a couple of weeks, perhaps it's not going to be that material to the markets or to the overall economy. But the longer it lasts, obviously it's going to be worse. We also have an interesting, as a research analyst, there may be a situation, depending on which departments get shut down, we may run into the data releases that come out that may not be coming out. And we've seen that happen in the past. And in a world where the world is very data dependent on policy outcomes, not having data could actually add to that data haze, if you will.
So a lot to potentially get worried about. Speaking of Ajita, let's talk about the basis trade. Of course, we're talking about that small difference that we see in pricing between cash bonds and Treasury futures. Jay, we saw an interesting warning from the Bank of International Settlements this week saying that basically if you look at the leveraged buildup of short positions, it's big enough that it could cause financial vulnerability should we see some sort of margin spiral take place here. When you think about how big the basis trade has become and these risks there, are you as worried as the BIS is?
You know, Katie, over the medium term, I think the increase in these sorts of positions could bring with it a reason to be concerned about financial instability, but I think you sort of need a sort of lever or something to kind of pull in order for that to be a massive source of concern. But to me, the growth in the basis trade is pretty natural. And we've talked a lot about how with the Treasury market moving gradually away from price-insensitive investors like the Fed and U.S. commercial banks and the foreign community, that more price-sensitive investors need to sort of pick up the slack here. And with Treasury supply growing, it's levered investors that sort of need to pick up the slack. So with volumes increasing, a higher likelihood that the Fed is close to, if not done with its tightening cycle, leaving more room for relative value trading, it's not necessarily surprising to me that the basis trade's picked up. It seems like it's still smaller than it was in 2020, and the Treasury market's bigger. So I think it's something to watch, but not right now to be 100% concerned about.
Well, it's a good note to end it on. Really appreciate both of your time. That is Jay Barry. He is co-head of U.S. rate strategy over at JPMorgan, and Morgan Stanley Global Director of Fixed Income Research, Vishy Tirupattur. Thank you both. Have a great weekend. Now, up next, the auction block, where there was a flurry of sales ahead of the Fed decision this week. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where we had a quiet end to the week with 3 straight zero sales days for U.S. high-grade bonds. We did, though, have a flurry of action ahead of the Fed. There was $16 billion in sales for the week, highlighted by companies such as Hyundai and UBS. We also got strong demand for WorldPay's debt sale. The combined offerings drew about $20 billion of orders in a deal to fund the partial leveraged buyout of the company. It's the largest LBO financing package since Twitter. And over in Europe, Bayer saw strong demand for its offering of new hybrid bonds. It follows the trend of recent hybrid offerings from companies like Volkswagen, which also saw a strong order book. Meanwhile, we caught up with Apollo's Torsten Slok about default risk.
Particularly in high yield, where default rates are now up to 4.3 in the data for August that just came out, that could continue for the next 6-9 months. And that's then going to open up a risk that if we begin to see the cost of capital bite harder and harder on companies every single day that cannot either get a new loan or refinance an existing loan, we begin to run the risk, of course, that we'll begin to see more companies defaulting.
Let's bring in now UBS head of credit strategy, Matt Mish, and Winnie, Cisar, global head of strategy at Creditsights. And Matt, I'll start with you, because when it comes to default risk, it feels like this boogeyman that we've been talking about forever that we haven't really seen materialize. But when you think about how high real rates are and how high Jerome Powell would like them to stay high and for how long, could we actually start to see a pickup here?
It's been really interesting. I think, tactically, we've gotten a little bit less bearish, and really it's because you've seen stabilization in some of those key metrics, which we think are the leading edge of default. So, 3 I would highlight. One is bankruptcy filings have seemed to stabilize, albeit at high levels. Middle market or private credit defaults for the second quarter actually moderated about 0.3%. And then leveraged loans obviously has been a big area of focus, certainly for us and for your viewers. And you've seen ratings migration stabilize in August and then September to date. So I think really it's a question of time horizon. In the short run, we're feeling a little bit more surprised, candidly, at the resilience of some of the default and stress metrics. I think longer term, though, as you allude to, the biggest risk, certainly after the Fed, is the potential for no landing, higher for longer. And certainly, so you get more concerned when you go into 2024 about the potential scenarios for default rates in the U.S.
Well, Matt, it's refreshing to hear that you're feeling, a little less bearish. Winnie, when you look at the fundamentals of the corporate credit market, are you on the same page or are you feeling a little bit more worried?
So I would say that we're actually feeling a little bit more worried. And I would caveat that with kind of the backstory that we were feeling quite good about 2023 in the corporate credit market. We started the year very constructively and have been just slowly ratcheting down our risk tolerance more toward a carry position. We do think that looking ahead, the headwinds in 2024 could start to grow quite considerably, especially if the Fed is on hold at this elevated level for an extended period of time, into the back half of the year. That's not our base case expectation. We actually think that the Fed will be able to start cutting a little bit sooner than the market is anticipating. But I think that that's because we do expect some deceleration in some of the sectors that have done really well, consumer discretionary, for the past 12 months as the broader consumer starts to slow down a bit.
And it's interesting to hear you say that. I want to talk a little bit globally here, because when we think about, again, very high rates and how high they might stay, the point has been made many, many times that a lot of companies got ahead of this, that they've refinanced. And Matt, I want to bring this to you because we had an interesting conversation at Bloomberg's Global Credit Forum in London with Akshay Shah, of Kaima Capital, who made the point that if you have floating rate bank debt, that transition mechanism is pretty immediate. If you've got fixed rate debt, you're going to have to refinance your bonds. The European market has done a pretty poor job of refinancing out their maturities. And I want to get to floating rate debt. But Matt, when you think about the differences between U.S. corporates and European corporates, do you agree with that sentiment?
I think it depends on how far you look out. So we think in general that liquidity, cash on balance sheets, and fundamentals are going to be resilient in Europe through the end of the year. I think as you look into that large 2025 type maturity wall, a lot of investors are certainly focused and more concerned as you look into next year. And we've shown about 120 billion odd in debt coming due for European high yield companies over the next several years. So I think the short answer is, again, it depends on time frame. In the short run, we're not overly concerned. Longer term, and with the ECB optically staying at close to 4%, it definitely is going to present some problems, but a lot of that is contingent on the economic environment.
And when we think about the other component of what Akshay was saying there, Winnie, it's interesting to hear the call on floating rate debt, because I take a look at ETFs all the time, and the products that track senior loans and the products that track CLOs in particular have seen many, many months of inflows. Is floating rate debt the way to go here versus fixed rate?
I would say looking ahead, we actually have a preference for fixed rate over floating rate. Floating has clearly been where you have wanted to position for most of 2023 and all of 2022 as well. But we do think that that is going to start to shift as we do see some of the refinancing needs and this elevated interest rate environment starting to really impede floating rate issuers. When we just look at the leveraged loan market, fundamentally, it's a bit lower quality than the high yield bond market is. And we think that going forward, the preference should be actually for fixed over floating.
Matt, is that your read as well, that really the juice is all out of that floating rate trade?
Yeah, a lot depends, obviously, on your economic outlook and your view on rates. But the short answer to your question is yes. We ultimately think there's a slowdown coming and a recession toward the end of the year. We think that spreads are tight. You have high grade spreads at about 120 basis points, high yield at 380 basis points. We think the right level for those is more like 135, 140 near term, and 450. But yields are harder to argue. The attractiveness of IG getting close now to the high 5% level or 6%. High yield now this week through yesterday, closer to 8.75%, in some cases 9%. The overall all-in yield picture is still, we think, more attractive. And we're seeing that in the flow data, and you're seeing buyers come in, most notably insurance companies in the US in the long duration or longer part of the IG curve.
And just to wrap that into your earlier point, that you've been surprised at the resilience of some of these corporates, Are you willing to risk or go out for credit risk here?
We ultimately think that if you're looking for your viewer that has a total return or a typical bond fund, that the attractiveness of interest rates here offsets the risk of spread widening. So the short answer is, for somebody that in most cases owns a total return bond fund, we would look to go out the curve. We think the curve will flatten as the spread curve, as the interest rate curve steepens. And we're generally thinking that lower rates and lower U.S. yields will largely offset, or I should say more than offset, any sort of spread widening here.
And Winnie, in 30 seconds, I'll give you the last word. Where are you feeling on the risk appetite spectrum?
I would say that we're feeling much more neutral. We have some parts of the market that we're favoring. We like a barbell strategy with front end and then 7 to 10 year investment grade bonds. We think the high yield double B market still looks very attractive from a risk reward perspective. And we still like high yield energy as well.
All right, guys, great place to end it there. Really appreciate both of your time. That is UBS Head of Credit Strategy, Matt Mish, and Winnie Cisar, Global Head of Strategy over at Creditsights. Thank you. Still ahead, the final spread. The week ahead features a wide range of economic data. We'll get into it next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead, coming up, we will have a slew of U.S. economic data ranging from durable goods to PCE to home sales to personal spending. Of course, we're also going to hear from central bank leaders such as Jay Powell and Christine Lagarde. But let's talk about those estimates for PCE. Of course, it's the Fed's preferred measure of inflation, and you're expected to see core drop as headline continues to heat up. That mirrors what we saw in CPI. Expected to see the same thing with PCE, and that divergence that we see between headline and core, maybe it'll grow if we continue to see energy prices continue to climb there. And what that means for the Federal Reserve, we'll see. But from New York, that does it for us. Same time, same place next week. This is Bloomberg Real Yield, and this is Bloomberg.